investment in shares, or basically an investment in what? An investment in debt instrument. Yes. So I want us to have a discussion on this financial liabilities before we take a short break, and then we come back to do a question. So if you're done basically with what we have up there, I think we can move and discuss on this. Yes. So financial liability. What is a financial liability? A financial liability, basically, we can say that this is a contractual obligation. This is a contractual obligation to do what? To pay cash. This is a contractual obligation to do what? To pay cash. So here, an entity or basically a company has entered into a contract, and in that contract, the company has an obligation to pay what? To pay cash. Now, generally, financial liabilities, these are the debt instruments which have been issued by the company. So these are the debt instruments issued by who? By the company. The debt instrument, e.g. debentures, e.g. bonds, which have been issued by who? Issued by a company. Issued by who? By a company. So therefore, if you come across a question and you're told company X here, for example, issued debentures, the company X issued bonds. So to this company, this is a financial what? Liability. And therefore, you need to differentiate between financial assets and financial liability. So financial asset is whereby a company will have invested or a company will purchase debentures or what? Both. So if you invest, you purchase both or debentures, to you is an asset. But if a company issue debentures or if a company issue both, to the company is a financial liability. To that company is a financial what? Liability. Because once a company issue both, once a company issue debentures, the company has an obligation to pay cash. Now, which cash will our company be required to pay here? Assuming our company issued both or basically debentures having a life of 3 years. It basically means that this company, over the next 3 years, at the end of each year, our company has to pay interest. Once the 3 years come to an end, the company will have to do what? To redeem those particular debentures or bonds in terms of paying back the principal amount. In terms of paying back the principal amount. So therefore, here you can see our company has entered into a contract, and in that contract, the company has an obligation to do what? To pay cash. Yes. Now, in this case, we have two categories of financial liabilities, but majorly we will discuss on one because that is the one which is very common. So we have a financial liability at fair value through profit or loss. So basically, these ones are not common. I will not even discuss that. But basically, just know we have two categories. And then number two, we have financial liability at amortized cost. These are the common type of what? Of financial liabilities. The common type of financial liabilities which are issued by the company. The financial liabilities at amortized what? At amortized cost. Now, these are basically the debt instruments which are issued by the company, e.g. debentures or bonds, which are supposed to be redeemed after a number of years. In other terms, you can say that these are the debt instruments which are issued by the company. They have a fixed rate. They have a fixed rate. A fixed rate means, for example, a company, you can be told a company issued debentures or basically bonds having a life of 3 years. Having a life of 3 years means that those debentures or those bonds can only be redeemed by the company at the end of the 3rd year. Can only be redeemed by the company at the end of what? The 3rd year. They have a fixed life. They have a fixed what? Right. So therefore, that's why we are saying that these are the common type of what? These are the common type of financial liabilities, which are basically issued by what? By the company. Now, what you then need to know, as far as these financial liabilities are concerned, are two things. The amount for initial recognition, how do we determine the amount for initial recognition, and how we determine the amount for subsequent measurement. How do we determine the amount for initial recognition, and basically the amount for subsequent measurement. So when we talk about the amount for subsequent measurement, we are referring to the amount at which these financial liabilities, will be recorded in the company's statement of financial position at the end of each year. Now, the amount for initial recognition, or once the company issued this debt instrument having a fixed value, they are initially recorded in the company's books of account at what? The fair value of purchase consideration. The fair value of purchase consideration received. The fair value of purchase consideration received. How much amount was received by the company? Fair value of purchase consideration received minus any transaction cost. Minus any transaction cost. Like in this case, you can be told a company issued debentures, and those debentures which were issued, they were issued, or the company issued them at an amount of 200 million. So 200 million, the company issued shillings 200 million debentures, but during the issue, the company incurred a transaction cost of maybe 2 million. This is the transaction cost which was incurred by the company. So the amount for initial recognition will be equal to the fair value of purchase consideration received. The amount the company received is 200 million. We minus the transaction cost. The transaction cost is the cost incurred in the year issue, which is 2 million. So the amount for initial recognition, therefore, will be 198 million. So the purchase consideration received minus any transaction cost. Then, what about the amount for subsequent measurement? The amount for subsequent measurement, this one is equal to the amortized cost. This one is equal to the amortized cost. Now, for us to be able to determine this amortized cost, we must prepare something called the amortization schedule. We must prepare something called the amortization schedule. The amortization schedule, similar to what we have done here, although we will be able to see there is a slight difference because what we are dealing with here is a financial liability. What we have dealt with in the other question was a financial asset. We will be able to see there is a slight difference in terms of how we prepare the amortization schedule in case of a financial asset and also in case of a financial liability. So I want us to do a question on this once we come back after a short break. There was a question which was examined on this in this sitting, the sitting of April of 2025. If you go to those papers for FR, the papers for FR, let me share those papers in the class WhatsApp group. So we have this question here, April of 2025. And this was specifically question number 4B. Question 4B. So this is from your papers for FRA. So I want us to take a short break of how many minutes? We can just take a short break of just 5 minutes. 5 minutes. We come back. Make sure you have that question with you. The question for April 2025. April 2025, question 4B. So let's come back after the short break of 5 minutes, and then we look on that question. Yes. So I want us to proceed. Let's proceed. Let's continue so that we wind up with this particular question here. A small one, but you'll also be able to see that it involves some workings here. So what have we told? I hope you have that question with you. Abdinasil, do you have that question with you? Jeffa, Stephen, do you have that question with you? Do you have that question with you? Ridian, are you there? Okay. So what have we told here? A small question, question number 4B. It reads, on 1st January 2021, Trades Limited issued shillings 20 million. 8% raw notes at a discount of 5%. The issue cost amounted to shillings 1 million. Then in paragraph 2, you're told the raw notes were redeemable on 31st of December 2024 at a premium of 1,130,000. The effective interest rate will be, or therefore, is 12.5%. So we are told with suitable calculations illustrate the accounting treatment of the above transaction from 1st January 2021 to 31st of December 2024 in the financial statement of Trade Limited in accordance with IFRS 9 financial instrument recognition and measurement. Round your answers to the nearest 1,000, to the nearest 1 1,000. So we are told this company, first of all, which is called Trades Limited, issued shillings 20 million, 8% roll notes. So we have said if a company issued debt instrument, roll notes and debt instrument, basically this is a financial liability. And actually you have said that because they have a fixed rate, because you can see that these roll notes will be redeemed on 31st of December 2024. So these are debt instruments issued by the company. They have a fixed rate. So basically, what that means is that these are financial liabilities at amortized cost. So we can say these roll notes. This is basically for your revision is not required by the examiner. Here we can say these roll notes issued by who? Issued by Trades Limited is what? Is a financial liability at what? At amortized cost. Is a financial liability at amortized cost. Now, having known that, we need to proceed and basically we determine amount for initial recognition. Amount for initial what? For initial recognition. Remember, in this case, we were issued on which date? They were issued on 1st January 2021. 1st January 2021. 1st January 2021. Now, for us to be able to determine this, you must remember the formula which I've given you. And we have said that the amount for initial recognition is equal to the fair value of the purchase consideration, the fair value of purchase consideration which was received minus any transaction cost, minus any transaction cost, minus any transaction cost. How much amount was received, and then to that we less the transaction cost. Have we given this information? Yes. Let's go back to paragraph 1. And basically you're told that on 1st January 2021, this company issued shillings 20 million. This 20 million is the nominal or the par value, 8% loan notes at a discount of 5%. At a discount of 5%. In this case, you can see the loan notes issued, they had a face value of 20 million, but were they issued at 20 million? No, we are told they were issued at a discount of 5%. So therefore, the amount received, the purchase consideration received by our company here, this one will be equal to 95% of 20 million. 95% of 20 million, because they were issued at a discount of 5%. This is the fair value of purchase consideration received. And then to this, we minus the transaction cost. Do we have transaction cost incurred by our company here? Yes. We are told in the first paragraph, the last sentence, the issue cost amounted to 1 million. There was an issue cost. The issue cost is the transaction cost, which is basically what? 1 million. And I think what we need to do, equally, if you check on the requirement, we are told to work with our figures to the nearest 1,000 of shillings. So just like what you have done in the other question, we will work with all our figures in 1,000 of shillings. We omit the last 3 zeros. Yes. So we take 95% of this, and then we minus the transaction cost. We minus the transaction cost. This will give us what? 95% times 20 minus 1,000, and that will give us what? That will give us 18 million. That will give us what? 18 million. This is basically the amount for initial recognition. In this case, equally, you may show the accounting entry. So this amount, how was it supposed to be accounted for by our company? So in this case, our company received the money. So the amount, this is the money which was received by the company after issuing roll notes. So the company debited that in the bank. The amount was debited in the bank and then credited in a liability account called the financial liability at amortized cost. This is basically a liability account which was credited with the amount which was received. Having determined the amount for initial recognition, we need to move and basically determine the amount for subsequent measurement. For subsequent what? Measurement. Remember, this amount for subsequent measurement is basically the amount at which these financial liabilities or the amount at which these roll notes will be recorded or was supposed to be recorded in the company's statement of financial position, I think over the period of 4 years. So this, if you can be able to recall, we have said the amount for subsequent measurement is always equal to the amortized cost. Is always equal to the amortized what? Cost. And actually, we have said that these amortized costs we'll have, or actually we're going to determine this amortized cost by basically preparing something called the amortization schedule. So that is basically what I want us to prepare. We prepare the amortization schedule. So we need to determine the life of these raw notes. In paragraph 2, I think, in paragraph 2 of our question, we are told the raw notes were redeemable on 31st of December 2024. They were supposed to be redeemed in on 31st of December 2024. Remember the date they were issued. They were issued on that date. They will be having a life of how many years? 2021, 2022, 2023, 2024. They have life of 4 years. So we need to prepare the amortization schedule for those 4 years. We will have, therefore, a column for years. Basically, the first year will end 31st of December 2021. The other 31st of December 2022. The other 31st of December 2023. And 31st of December 2024, like that. Then our next column here will be for the amortized cost at the start of the year, the AC at the start, and remember all our figures are in thousands of shillings. The next column here will be for the interest, but basically here, this is an interest expense. If you can recall the other question, for financial asset, we had interest income. So once the company invests, the company receives or should recognize interest income. But once a company has issued raw note, the company should recognize interest expense. Now, this one will be computed equally using the effective interest rate. Are we given the effective interest rate in our question? Yes. In the last paragraph, we are given the effective interest rate. In the last paragraph, the last sentence, which is basically 12.5%. Then we have the next column here. Will it be for the cash received? No. Our company has issued raw notes. So our company will be paying some cash. And actually, to compute this one, just like what you have done in the other question, we will take the coupon interest rate. We multiply that with the face, or basically with the nominal value of this raw note. I hope you can be able to remember the nominal value. Who can tell us the nominal value for this raw notes which were issued? Jeffa, Felix, Stephen, Ridian, what is the nominal value for this raw note? It's similar to the other question. Similar to the other question which you have done for the financial asset. Yes. So this is basically the face or the par value. The face, the nominal, or the par value. So this will be equal to the coupon interest rate times 20. And then finally here, we have the column for the amortized cost at the end of the year. That is basically balance carried down. And also remember all our figures here are in thousands of shillings, like that. All figures are in thousands of shillings. So you can see there is no much difference. So the only difference is that in case of a financial liability, here we have interest income. In case of financial asset, here we have interest income. In case of financial liability, here we are having cash paid. In case of financial asset, we are having cash received. That is the only difference. Sawasa? Yes, that is the only difference. So what do we start with here? We start with the amortized cost at the start. Just like the other question, this is the amortized cost at the start, which is basically what? 18,000. So then we compute interest, which will be 12.5% of that. So let's get that one. 12.5% of 18. And that will give us what? That will give us 2250. The cash to be received, I've said we take the coupon interest rate. The coupon interest rate is what we have in paragraph 1. Coupon interest rate in paragraph 1 is given as what? Is given as 8%. So this one will be 8% of the face value. The face value is this one, 20. 20. And basically this will give us what? That will give us what? That will give us what? Yes, that will give us 1600. So this is 1600. And basically, just like what you have done in the other question, to determine the amortized cost at the end, we will take this plus this minus that. The same with what you have done in the other question. So what do we get? We're getting 18 what? Is it 18,650? Yes. So that now would be the opening balance here. 18,650, we get 12.5% of that. So you're getting what? Yes, to the nearest whole number, 23, 31. This remain the same. Minus 1,600. And basically, what are you getting here? 19,381. So this plus this minus that. That's what you're getting? 19,381. Yes. So that will be the opening balance here. 19,381. So we compute interest being 12.5% of this. So which will give us 24, 23. 24, 23. So these remain the same. 19,381 minus 1,600. And that will give us 204. Yes, 2204. Is that what you're getting? And basically that will be the opening balance here, 2204. Yes. So we get the interest, which will be 12.5% of that. And that is 25. Now, at the end of year 4 here, they will be redeemed. They'll be redeemed. So the amount to be received here, will be equal to the coupon payment, this one, the coupon payment over 1,600 plus the capital repayment. So what are we told in relation to the redemption? Let's go back to our question here, specifically paragraph 2. Paragraph 2. We are told in paragraph 2, the loan notes will be redeemed at the end of 2024 at a premium of 1,130,000. So the amount to be paid here will be equal to the nominal value, this one, plus a premium of 1130, plus a premium of 1130. Is there any difference with the other question which you have done? No much difference. No much difference, because even in the other question we had a premium. We have taken the nominal plus what? Plus the premium. The amount to be paid here, therefore, will be 16, this one, the coupon payment plus the capital repayment. And basically this will give us 22,730. So once we compute this one, basically that one should be 0. Should be what? Should be 0. Sasa? Yes, yes. Now, having that, we now need to prepare the financial statement extract. And we will start by preparing the statement of a profit or loss extract. The statement of profit or loss extract basically we show what was supposed to be recognized here over the period of 4 years. 31st of December 2021, 31st of December 2022, 31st of December 2023, 31st of December 2024. And basically, our figures here are in thousand of what? Of shillings. So basically, I've said what our company was supposed to recognize here is this one. And you can see this is an expense. So this interest expense was supposed to be recognized here as what? As an expense. Other expenses, our company was supposed to recognize interest expense. And this interest expense, in other terms, we can also refer to this as a finance cost. The finance cost for the first year is 2250. For year 2 is 2331. And basically for year 3 is 2423. And finally is 25. So this is what was supposed to be recognized in the statement of profit or loss as an expense. Finally, we prepare what? The statement of financial position. Statement of financial position still extract. Statement of financial position extract. And remember, we have said that these loan notes which were issued by our company, these are liability. This is what? A liability. So basically, remember you need to prepare these for 4 years. For 4 years. 4 years here. 4 years like that. And also we need to indicate that our figures are in thousands of shillings. Yes, now this Financial liability at amortized cost to the company is a liability, actually a non-current liability. A non-current what? Liability. So under the non-current liabilities, our company here was supposed to recognize something called the financial liability. The financial liability at amortized cost. Financial liability at amortized cost. And actually, this one will be recognized here as this amortized cost. The amortized cost at the end of year 1 is this one, 18,650. Year 2 is 19,381. Year 3 is 20,204. And basically at the end of year 4 is what? Is 0. Is what? Is 0. So basically this, what now the examiner is requiring, this financial statement extract. This financial statement extract. And basically by doing that, you get how many marks? You get 8 marks. You get 8 what? 8 marks. You get 8 marks. So that's basically how we account for these financial liabilities. That's how we account for the financial what? Liabilities. So therefore, these are some of the questions we are likely to come across as far as that topic of financial instrumental are concerned. I hope you can see there was a question coming from this topic on compound financial instrument, a question we did in our previous class. You also likely to come across a question on financial assets, what we did at the start of this session, and also you're likely to come across a question in relation to the financial liability. So what you just need to do, can you try to redo those particular questions again on your own, and you try to identify the difference between financial assets and basically financial what? Financial liabilities. But basically now that brings us to the end of that topic on financial instrument. It basically means that once we meet now in our next class, which will be next week, basically we are moving to a different topic. We will move to a new what? To a new topic. So therefore, for today, I think we will stop at that point because I know you have another class from 4. I want you to have just a short break before the next class starts. So any question before we wind up? Is there any question before we wind up? Any question before we wind up? Any question before we wind up? I think there is none. So let's stop at that point. Have a nice weekend. See you next week on Tuesday as we move to another topic.
We are recording, so now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time the value of money changes. The value of money does not remain the same. And I'm saying, assuming here now that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money. Introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding. Concepts of compounding. concepts of compounding or compounding techniques, and we start with the first one, future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management, and that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing. But all in all, let's just write an example there. Just write something, just write an example, an illustration, say an investor intends to invest, shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period. Period. 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due